Hello everyone, and welcome to the 2018 and 2019 tax update. I am the presenter for the business tax portion. I'm Steve Wuest. I'm a senior manager in the business tax and consultation side.
And I'm Kevin Woodworth, and I'll be covering the personal tax changes that we'll see here for 18 and touch on a few 19 updates. But the first thing that we wanted to go through, just kind of give a little background. I'm sure as everyone is aware, there's this big government shutdown going on right now. So what does that mean from a tax filing season perspective? And what we can see right now, there's really no end within sight of this shutdown, but the IRS can continue to work on some guidance related to the Tax Cut and Jobs Act during the shutdown, but vital taxpayer services like calling them, if you try to call right now, you're not going to have any luck getting a hold of anyone. But then the other issue that came up was, well, will there be any refunds issued during the government shutdown? And they did come out and say that refunds will be issued even if there's a shutdown still going on.
So we'll start by going through some of the headlines. 2018 was an especially big year for tax law changes. There's changes every year, but this one was especially large with sweeping changes across the board for business and personal tax. So the three major ones that you might have heard about are new 21% tax rate for C Corps. There's a 20% deduction for pass-through entities, including sole proprietorships, and lower individual tax rates. Now, it's not as straightforward as that. There's certain different things that might impact your ability to receive these specific tax breaks, but we'll be getting into that in more detail as we're going through. So we'll start out with the business tax update, and then Kevin's going to go through things on the personal tax side. And we'll start with the C Corp changes. As I just mentioned, there was a tax rate decrease for C Corps. It used to be 35%, and it's currently dropped to 21%. And there's not really a catch with this. Most people will be seeing that 21% tax rate. But what a lot of people don't think about is that to get money out of a C Corp, you need to pay it out as a dividend, which is typically taxable when you get to the personal tax level. So you would get a 21% tax rate on the business level, but when you pay it out, it can be an additional around 20% on the personal level, which can equate to about a 41% tax rate. So when these first tax laws came out, a lot of people were thinking that it would be better to be a C Corp than a pass-through entity, but a lot of times that's not the case since you have to factor in the tax on the personal level as well. Other changes from C Corp standpoint, corporate AMT was repealed. There was some talk about having AMT repealed across the board, but Kevin will get into this a little bit later. There is still a AMT on the individual level, but for corporate purposes, it's gone. Also, some changes to net operating losses. They're currently limited to 80% of taxable income. You used to be able to offset 100% of your income with the NOLs, not the case anymore. Also, no more carrybacks for NOLs. You can only use them going forward. But if you don't use NOLs, you can carry them forward indefinitely. And there used to be a limit, but now the limit is no more. So let's get into the pass-through deductions. So this is a new thing called the Qualified Business Income Deduction. And it's a 20% deduction of qualified business income for partnerships, S-corps, and sole proprietorships. There's a lot of limitations that can come into play here. So a lot of businesses aren't going to see that 20%. But we'll be getting into that to see how you can position yourself to achieve as much of a deduction as you possibly can. So we'll be getting into the limitations. The first thing you need to look at is what your income is on the individual level. This is a little tricky because on the business level is where a lot of the deductions are generated, but you actually take the deduction on the individual level. And the first limitation is what your individual income is. So you'll see that if you make under $315,000 for married taxpayers and $157,500 for single taxpayers, then you don't have a limit. If you have qualified income, you do get that 20% deduction. If you're over $415,000 for married or $207,500 for single, if you're an SSTB, which we'll be getting into in a minute, you're not going to get a deduction. You're completely phased out. And if you're not an SSTB, the limits fully apply, which we'll also be getting into in a second. But just wanted to go through this because the first thing you should really be looking at is what is your income on an individual level, and that'll help you determine what limitations you need to think about. So, specified service trader businesses. These are if the principal asset of the trader business is the reputation or skill of one or more of its employees or owners. So examples: health, law, accounting, performing services, or performing arts, financial services. These are things where the argument from the IRS is that you're really just earning the income because of your efforts or your employees' efforts. It's not really an investment in any sort of equipment or a business investment, so it doesn't count towards the 20% deduction for pass-through income. And bear in mind that that's only the case if your income is over that threshold that we just talked about. If your income is under the threshold, even if you are an SSTB, then you can still get the deduction. So next, if you're not an SSTB, you have to factor in these other limitations. So the 20% deduction that you're eligible for is limited to the greater of 50% of wages or 25% of wages plus 2.5% of the original cost of tangible property. So for the most part, a lot of taxpayers are going to be using this 50% of wages because it's going to be higher and it'll make you eligible for more of a deduction. But for real estate companies, companies that have a lot of equipment, there are some where the 2.5% cost of tangible property plus the lower 25% of wages might get you to a higher deduction. So as you can see, this can be really difficult, especially because there's multiple layers of limitations to this deduction. A lot of taxpayers aren't going to see the full 20% that was the big headline that came out when the tax law was changing. But there are certain ways that you can position yourself to not be a specified service trader business, or if you pay out more wages or have more property, it might not be as limited. So the planning opportunities for this are pretty complicated. But if you have questions, feel free to reach out at anybody at Team DKB and we can help you out with that. So a few more major changes. Depreciation. Previously, you were able to get 50% bonus depreciation on short-lived assets, but now for the assets that qualify for bonus depreciation, it is bumped up to 100%. So you can take, for federal purposes, the full amount of deduction right away for short-lived property. This was actually implemented towards the end of 2017, and that's going to continue for 2018 and for the next few years. Also, Section 179, this was originally put into place for small taxpayers to be able to take the full amount of depreciation right away, but the amount of limitation and the amount of expense that you're able to take has greatly increased over the years. Now you have a limitation for the full expense of $1 million, and there's a phase-out threshold starting at $2.5 million of property purchase. So there's been a big increase in the amount of depreciation you can take, trying to stimulate businesses to acquire more property so you get them additional deductions right away. Another big change is this implementation of opportunity zones, which is a program to encourage investment in low-income areas. Governors of states are setting the opportunity zones for each of the states to try to figure out which areas they want to encourage growth in. And what this is if you have a gain, whether you're a business or you're an individual, you can take the gain funds and invest them in opportunity funds, which are investments in these opportunity zone areas. And there's a lot of tax benefits to doing that. You can defer the gain so you don't have to pay tax on it right away. And also, if you hold the investment in the opportunity fund for 5 years or more, you can reduce the overall gain you're paying. So for 5 years, you reduce the taxable gain by 10%. If you hold it for 7 years, you can reduce it by 15%. And if you hold it for 10 years, then you don't need to recognize any gain on the opportunity zone investment. So if you have gains and you're trying to look for opportunities to reduce the taxes you're paying, this can be a really good option as long as you're comfortable that the investment in the opportunity fund is a sound one. So if you could turn around and invest the money in a non-opportunity fund where you have a lot of confidence that it'll be a great investment, it could be better than investing in an opportunity fund. But if you feel like there's an opportunity fund out there where you'll get a good return, that's a really good spot to put your money because it has some tax benefits and it's also another investment that you can use. There's also a blog post that I had put out on DKB's website, and that gets in more detail about the potential benefits and how that all works. So wrap it up with a few other changes. DPAD is gone, which used to be a 9% deduction on production income. That is partially replaced by the 20% deduction for pass-through entities and also the lower C Corp rates. So even though that's gone, taxpayers might have additional benefits coming from some of the new programs that were in place. Technical terminations, no longer have to do anything with that. Previously, if a pass-through entity had changed ownership of 50% or more during the year, then you'd need to split up the tax filing between the period before the change and the period after the change and revalue the assets, and it was a big mess, but it's gone now, and a lot of accountants are very happy about that. So the other thing, business mileage rate, it was 53.5 cents per mile for 2017, bumped up a cent for 2018, and there will be a big jump for 2019 at 58 cents a mile. Meals and entertainment changes. Previously, entertainment was lumped in with meals as a 50% deduction for tax purposes, but with the new tax laws, entertainment is no longer deductible. So that can be things like going to a sporting event, where previously you were able to get a 50% deduction for it, but you're not able to any longer. And the last thing, like-kind exchanges. This is a vehicle where you are able to defer gain on the sale of property, and you're still able to do it for real property. So if you're to sell land or buildings, you're still able to defer gain on the sale as long as you turn over the gain into and invest in like-kind property. But no longer are you able to do it for personal property. A lot of times this would happen when people had a gain on the sale of a vehicle or did a trade-in. You would be able to defer the gain of on that sale, but personal property, you're no longer able to defer gain for that. So that's it for the major business updates. I'm going to turn it over to Kevin Woodworth to talk about the individual updates.
All right, thank you, Steve. So the first thing that we're going to hit on here is just the individual tax rates for 2018. So we've got the single tax filers and the married filing joint tax filers on the slide here. And the big change in 18 is lower tax rates overall. So in the past, the highest tax rate was 39.6%. The new highest tax rate is now 37%. As you can see on this next one, we've got a comparison of 2017 to 2018. And you can see on the left, the 17 rates, 39.6 being the highest. But you can also see for 18, the income thresholds are a bit higher on where some of these new tax brackets start. One other big change is the standard deduction. So the standard deduction essentially doubled for any of the filing statuses, and kind of what that means we'll get into here in a couple minutes, because the next thing I want to go through are changes to itemized deductions. So a lot of changes going on here. One, probably the biggest one, related to state and local income taxes as well as real estate taxes. In the past, you were able to deduct all of those. Now there's a cap of $10,000 for your income taxes plus real estate taxes. Another change is for mortgage interest. Although the interest is still deductible, there are new limitations depending on how much of a mortgage you have. So the old limitation was $1 million, which if you had a mortgage in place before 18, that's still the threshold, but any new mortgages going forward is $750,000. And then there was also a discussion about home equity line of credit. whether that interest was going to be deductible or not. And they did come out and say, as long as the line of credit was used to improve the residence, then that interest would be deductible. Investment interest expense is still deductible on Schedule A. Charitable contributions, those are still deductible. The income threshold for cash contributions actually went up from 50% of your adjusted gross income to 60%. Medical expenses, those are still around. There was a 7.5% threshold for 2018 you had to get over to be able to claim any medical expenses. That threshold goes up to 10% here in 2019. Casualty losses, you used to be able to deduct losses for things like a hurricane or earthquake. Now it has to be in a federally declared disaster area in order to get any type of benefit. If it's not, then it does not count. A big change as well was miscellaneous deductions. So those are completely gone now. In the past, you'd be able to deduct those subject to a 2% threshold. Those are completely gone. And then one other thing to mention here related to kind of us here in New York State is New York State has decoupled from federal law in this regard. So what that means is if you take the standard deduction for federal, you can still itemize for state purposes. So with these changes, you're going to see a lot more taxpayers claiming the standard deduction, mainly because of that $10,000 state tax cap. So if you're taking that standard deduction for federal, you still want to be able to get together your itemized deductions related to charitable contributions and things, because you'll still need that for New York State purposes. A few other items I just want to hit on quick on the itemized deductions. With more people taking the standard deduction, a lot of questions now come up with, okay, what should I do from a charitable perspective? So there's a few things that you can do. One is kind of lump contributions into 1 year, and that way you have more contributions in one and then not as many in the next. So you might itemize 1 year and take the standard deduction the next. Another idea could be to fund several years worth of charitable contributions and put those into a charitable gift fund. If you have questions on that, feel free to reach out to anyone here at DKB. We can go into more detail on what that means. And then the other thing is with older taxpayers that are at least age 70 and a half, when they have to start taking a required distribution, what you can do is you can make a direct contribution from your IRA to charity. And as a result, what happens is it lowers the amount of taxable distribution that you take. So that's a way of getting a benefit with still being able to take the standard deduction. Exemptions, so those have been completely repealed. In the past, there was approximately a $4,000 benefit there. Granted, it was phased out if your income was at a certain threshold. So a lot of taxpayers weren't even really seeing the benefit before anyway. And the reason for getting rid of that was the increase in the standard deduction and the increase in the child tax credit, which the changes in the child tax credit essentially went from a $1,000 credit per child to a $2,000 credit per child. And the real big factor was, in the past, the income threshold that started to phase out this credit was relatively low. For a married couple, it was around $100,000. That new threshold is $400,000. So what that means is all those taxpayers in that range will now be able to see a benefit from this credit. And with the credit doubling to $2,000, that could be very meaningful for a lot of taxpayers. There's also a small non-child credit. So if you have a child that's 17 or older, because the $2,000, the child has to be under age 17, you can get a $500 credit for that. And they also implemented a refundable piece of the credit. So what that means is even if you had no tax liability, you would still be able to get $1,400 back from this credit. Another big change was related to alimony. So in the past, if you received alimony payments, you had to pick that up in income. If you were the one to pay the alimony, you got a deduction for it. Now, if this was in place before December 31st, 18, you still can would have to pick up the income and get the deduction. This is for divorce or separation agreements executed after December 31st, 2018. Going forward, you're no longer going to have to pick up that income, and you're no longer going to be able to get that deduction. Now again, New York State has come out and said they are going to decouple from this as well. So what that means is, for New York State purposes, that income would need to be picked up, and that deduction you can take for New York State still. And there was a lot of talk about changing the Form 1040, and you can do your taxes on a postcard. So what you see here is essentially the front of the Form 1040 now. So in the past, there was a lot more information. Now this is just summarizing basically your personal information. And on the second page of the 1040, they have also taken a lot of information off of this page as well and put it into other schedules that are completely new. I won't get into all that detail, but just so you're aware of the changes to the 1040. Kiddie tax. So in the past, if you had a child that had unearned income of above $2,100, the tax that the child would have to pay in excess of that amount would be taxed at the parent's tax rate. Now that has changed. It's now taxed at the estates and trust rate and not the parent's rate. Another big change was regarding 529 plans. So for federal law, they came out and said you can take up to $10,000 out of a 529 plan and use it for K through 12 expenses. But that's only for federal. New York State has come out and said that they're going to treat distributions for K through 12 as non-qualified withdrawals. So what that would mean is you would pay tax on earnings from the distribution you take, plus you could have some recapture of contributions that you deducted in the past from New York State. So in terms of taking distributions for K through 12, you might want to think about it before you ultimately pull the trigger, because you could have some tax exposure for New York State. As Steve mentioned earlier, the AMT is still around for individual taxpayers. Having said that, I think there's going to be a lot less taxpayers subject to the AMT, and one of the main reasons is due to the fact that state and local income taxes are now capped at $10,000, plus miscellaneous deductions have gone away. Those were deductions that got added back for AMT purposes, which pushed a lot of taxpayers into the AMT. The combination of that and higher phase-out thresholds, I have a feeling we're going to see a lot less taxpayers subject to the AMT. Federal withholding changes. So with all these tax changes, what happened is the IRS came out and said, we're going to issue a new withholding table to try to get more in line with the changes in the tax rates. Essentially what we've seen is that doesn't necessarily line up. So what you could see is taxes going down, but with the adjustments to the withholding tables, you could see your withholding go down maybe even more than that. So in the past, maybe you saw a small refund when you filed your taxes, maybe you owe a little bit. Everybody's situation is a little bit different, so you'd have to kind of go through to see exactly what the changes are. And the IRS has come out and said, because of this and the uncertainty, they're going to change the way that the underpayment penalty is calculated. So in the past, as long as you had 90% of your current year taxes paid in through withholding or estimated tax payments, you had no penalty. They lowered that to 85% to try to factor in these withholding issues. So as I mentioned throughout, there are these New York State changes where they've decoupled from federal law. So the itemized deductions you can still take for New York State purposes. Alimony you'll still have to pick up in income and you can deduct if you pay it. Moving expenses, another one I didn't mention earlier, that's going away for federal, but you could still take it for New York. And then the 529 plan distributions we talked about. Just a few other quick things I want to mention. Estate planning, the exemption for that essentially doubled. So you're going to see a lot fewer taxpayers with a taxable estate, and the amounts will continue to go up a little bit more for 2019 to 22.8 million for married filing joint, 11.4 for single. And for 18 and 19, the annual gift tax exclusion is $15,000. So keep that in mind if you're planning on doing any gifting. Retirement planning. One thing that changed is you no longer are going to have the ability to recharacterize a Roth IRA conversion. So if you've done this in the past at all, or you have questions as what this means, reach out to us. We can go into more detail on this. You can still recharacterize contributions that you made, just the conversions is no longer able to recharacterize. And then the backdoor Roth, again, that's another thing that we will write a blog post about, that we can talk about. That's still allowed. So if you have interest in that, or what is that, feel free to reach out to us. And lastly, we just wanted to wrap up with a few key numbers for 18. Obviously, for a couple of these things, it's already over, so really thinking ahead to 2019, your 401k deferral limit is $19,000. The catch-up contribution, if you're 50 or older, is still $6,000. IRA contributions for the first time in several years is going to go up from $5,500 to $6,000. Now, for the 2018 amount, you still actually have time to contribute. For 18, you have all the way up until April 15th to make those contributions. So if you're like, should I contribute to an IRA? You still have time for 2018. And then lastly, the HSA contributions. That's another item that for 2018, you have up until April 15th. You can make contributions still. So if there's that thought and you have a high deductible plan, we can make additional contributions there for 18 still. And I think that's it for our update today. So like Steve and I both said, if anyone has any questions, feel free to reach out. We're more than happy to help answer any questions you might have, and we'll look forward to hearing from you.